Hello, John. Explain for a somewhat uninitiated investor what cat bonds are.
Okay. Well, cat bonds have been around for about 30 years, and they're one of the ways that investors can get exposure to pure insurance. You might think that you could get exposure to insurance through buying insurance equity or insurance bonds, but what you have there is a lot of market interference. So you've got the beta of the equity against the rest of the market, and you've also got massive asset portfolios within the insurance companies. So what we do with cat bonds is we basically extract the pure insurance and the levels of risk that insurance companies have to offload for regulatory and capital reasons. Sometimes there's an understanding that these are risks that are not good risks because the insurance companies want to get rid of them, but that's a mistake. This is about regulatory requirements for the insurance companies to move off insurance risk from their balance sheets because it's too expensive for them to keep it on. By taking on this kind of insurance risk, investors can get a very low correlated asset for the rest of their equity and fixed income portfolios. And so from an efficient portfolio theory, it's a perfect thing to add to their overall portfolios.
So where do you typically see, from your experience, people positioning this within portfolios? Is it about an income, a diversifier? What kind of asset do you think people view it as?
Well, it's definitely seen as a diversifier. I think the asset class picked up big time after the global financial crisis because it was able to give this uncorrelated income. And it was giving sort of a significant uplift to straight investments in fixed income bonds because the interest rates became so low that having anything that had A, income, and B, diversification was extremely hard to get. So from about 2008, 2009 onwards, we found that a lot of the pension fund consultants were recommending that their clients held between 2 and 5% of their overall assets in this kind of cat bond and insurance-linked security.
And how's the market evolved in recent times? Are there more payouts when natural disasters occur, or what has happened there?
Well, this is a market that follows the insurance cycle, and the insurance cycle sees waves of capital coming in and then pricing reducing, and then when you have big events, pricing going up, so more capital coming in. What we've seen in the last 4 or 5 years is that there have been a number of big events in the US, in Canada, in Australia, that have caused quite a lot of losses. So we've seen over the last 2 or 3 years significant rises in the returns on this asset class, and at the same time a tightening of the conditions. So we're getting better returns for lower risk. And that has meant that there is a historic opportunity for investors to look at this asset class very closely. It's one of those things that intuitively is very easy to understand, but requires quite a lot of hard work to get into the nitty-gritty, because there's a lot of details and a lot of understanding required to actually make the right choices in this area.
And more specifically, how do you differentiate yourself from others that may participate in the sector and perhaps even look for similar but not exactly the same types of investment cycles, the flows, etc.?
So Leadenhall Capital Partners was set up by myself and some other Swiss Re people about 15 years ago. And what you require in this sector to make a success of it is a deep understanding of insurance and reinsurance, and where the best returns for the lowest risk are. In order to be able to do that, it helps to have connections with an insurance company. And our parent company, who bought out a majority stake about 5 or 6 years ago, is Mitsui Sumitomo Insurance. So we can tap in to some of their knowledge and some of their contacts in terms of our decision making and our research. But at the same time, we make independent decisions all the time in order to ensure that we have an alignment with our investors rather than with any of the insurance companies.
And finally, what is the biggest potential issue you think investors should focus on if they're looking at this asset class during the next couple of years?
I think the real question is whether they can get their sort of investment committees and general decision-making sort of bodies to understand this very quickly. There is a historic opportunity. I think for figures that can be shared with people, the rates on these kind of assets are the highest they've been for about 30 years. But that will attract new capital. I think people should be looking at trying to make allocation decisions very quickly and then see how those sort of work within their overall portfolio construction.
Well, I think most investors will be most fascinated by this. Thank you, John.
Thank you very much.